But if you have a widespread failure where there's all these claims for base dollars that vastly exceed the number of base dollars, and instead, banks have a lot of exposure to risky, illiquid loans that are either unable to be moved around easily and converted back into cash, or if they are at risk of defaulting and therefore losing a portion of customer deposits. And so what they did back in 2008, in part, was that they created a ton of new base money. And they said, well, we're going to create a ton of new base money. We're going to buy some of those assets to reliquify the system. And so, I mean, it's not an exaggeration to say it's essentially like a Ponzi scheme. It's just something that has to keep going and keep growing in order to function.
Lyn Alden is a respected financial analyst, researcher, and writer who focuses on macroeconomic trends, investing, and finance. Lyn is known for her in-depth research, analytical approach, and clear communication style, and she has been featured in numerous publications, including Forbes, Bloomberg, and the Wall Street Journal. She also runs a popular investment website where she provides analysis and commentary on a range of financial topics, and she manages an investment portfolio that she shares publicly. In this video, Lyn talks about the banking system, especially the fractional reserve system, which banks use to create new money. Under this system, banks only keep a fraction of their deposits in reserve and lend out the rest. This practice of creating money out of thin air is similar to a Ponzi scheme, as the system relies on an ever-expanding supply of debt to keep the economy growing. She also argues that banks create too much credit, leading to inflation, asset bubbles, and financial instability. She talks about Bitcoin's settlement and how its fast network and scalability will take banks out of business when massively adopted. She also went ahead to talk about the central banks and how they differ in terms of the rare occurrence of bank runs and other risks that commercial banks run into. This video is a full expository of the banking system. We hope you'd enjoy it. Don't forget to give us a like, subscribe, and drop your comments below.
Basically, it's one of the cheapest source of funding available. I mean, that's a key thing that a bank does, is that they're able to borrow interest very, very low, and then they're able to lend it out at higher interest rates and collect that. And there's very different types of banks. There are investment banks, there are commercial banks. Some banks are very simple, some are very complex. But at the end of the day, what their primary purpose is they're providing checking services, they're providing saving services, they're providing services. But at the end of the day, those are a liability for them, an asset for us. And so they're borrowing money. It's actually insurance companies kind of do the same thing. They collect premiums, they pay out claims, but in the middle, they're holding this big float, and they can generate, they can invest that float. They can collect income on their investments by holding things like bonds, and then therefore that's what represents income for an insurance company. And you essentially see the same thing with a bank. Basically, most of the modern financial system that we built up over a long period of time is this kind of arbitrage where banks are arbitraging the fact that they have a bunch of depositors that are coming and going, but in aggregate, most of their total assets, their total liabilities are not changing very frequently, and so they have this kind of permanent, low cost source of borrowing that they can lend out for longer periods of time in slightly higher risk capacities. And by having diversification, by having sufficient liquidity on hand to handle withdrawals, most of the time they're fine, and they generate that income, and then they pay themselves, they pay their shareholders. It's basically a big middleman operation, and that's how things work. And obviously, back a long time ago, this was a really valuable service because if you're talking about, like, say, depositing gold coins at a bank and getting like a banknote for them, you're speeding up, you're getting better divisibility, you're getting all these services. Even today, many of us use banks because we're getting something from the relationship. We're able to, connect into this big global set of ledgers, move money around, not have to store a bunch of physical cash like in our home. Obviously, there are some recent alternatives that we can use, like, say, Bitcoin, for example. But prior to Bitcoin, this is kind of the best we have. And so that's the world we live in. I think when you have the underlying settlement asset move as quickly as something like Bitcoin does, either fractional reserve banking doesn't make sense, or the ratios that are workable are so much lower than the current ratios we have now that you can get up to, like, say, 23-1, for example. That type of ratio completely goes away when the underlying settlement asset can move very quickly, and you don't really get any advantages other than yield for having it in one of those. So for example, back in the free banking days, besides yield, the advantage you got for putting your your gold in a bank is one, you didn't have to worry about custody it anymore, and two, you're now tied into this telecommunications connected ledger system, and you can move claims around faster. So you put it in, you get higher velocity from it. But in a world where it is safer to secure the underlying, let's say for example Bitcoin multisig, you only have to worry about storing massive amounts of gold in your home. And two, if the underlying moves just as fast as bank ledgers do, then there's less of a reason to ever put it at risk in any sort of fractional reserve way, or at least any significant fractional reserve way. And so I think that's the changeover.
A fractional reserve system increases the potential for inflation, asset bubbles, and bank runs. This in turn can lead to a global financial crisis. Lyn Alden breaks down the fractional reserve system and how it works. She also drops her insight on how to cushion the effects of such a system.
Let's say the monetary base was gold and these were all claims for gold, and you had 5 times as many claims for gold, then the answer was, some of those claims would not be met. Those would be, defaulted on, and people, thought they had deposits, but they were fractionally reserved, and some of them are gone now. In the current system, because the monetary base is flexible, it's basically just it's a central bank ledger. Instead, what generally happens is if the system starts to collapse, starts to freeze up like it did in 2008, they instead rapidly increase the monetary base. And so you instead kind of spread it out via inflation and currency dilution rather than defaults. And so that's kind of the current era that we're in. And one way when you zoom out, it kind of goes back to that thing, like if a product is free, I mean, you're not the customer, you're the product for someone else being a customer. And so, for example, if you're, there are custodians out there, right? If you're, for example, an ETF is in many ways a custodian. They're holding a bunch of stocks, for example, and they're a wrapper around stocks, and they charge a very low expense ratio to hold those stocks, or if they're an active ETF, to choose which stocks to hold. But even if it's just a passive ETF, they're just following an index, they're basically holding the stocks for you, they're administering the details and charging a small fee for it. And that's a custodian relationship. Same thing if you have gold in a vault somewhere, normally you're paying a very small fee in order to maintain that, because they're not lending your gold out. Their income comes from you as the customer. Whereas if you're not really paying much, or even if you're getting paid, then you're essentially the product. In this case, you're providing a low interest rate loan to them. And the relationship we have with the banks is a little bit of both, because in some ways we do pay fees. We might pay a fee for a wire transfer or something like that, but we also, earn interest, or at least we used to, and now we kind of do around the margins, because we're the ones providing that low cost loan to them. And this is the system we've been in for quite a while. I generally separate beneficial and harmful as that's one axis versus inevitable or not inevitable. So I think kind of the way I put it is that it's inevitably going to happen, at least with the current and the prior level of technology that we had for the past couple centuries. That is essentially, anytime you have a custodial service, like you're depositing your gold, you're getting claims for that gold at a future date, those people inevitably realize, wait a second, most people don't come and take the gold out at the same time, and therefore I can use this. And then you start to get market pressures, like all these different custodians are holding your gold, and they're all charging fees. And then someone says, wait a second, if I lend 20% of this out, I can generate some income from that, and then I can charge my customers no fees, and they all want to use my service instead of my competitors. And if they don't disclose that to customers, it's fraud. But if they do disclose that customers might say, well, I mean, if you're loaning out 20% of it, that sounds reasonable. If they're, secure lending practices and so forth, it's 80% backed by gold, is 20% backed by, less liquid loans. Sure, I'll take that trade-off. And then another one might come along and say, we're going to lend out 40% of it. And not only are we going to make the custodian free, we're going to then pay you a little bit as profit sharing. Right. And so there's kind of, I think it's one of those things where if you have a mismatch in speed between the claims and the underlying, right? So gold is slow and bank accounts are quick, you're going to get that arbitrage. And banks are going to make use of that arbitrage. That's why once fractional reserve banking was a thing, it spread everywhere. And so I think it's one of those things where it's inevitable in that current era of technology. Basically, market forces are going to keep pushing in that direction. Whenever they push it too far, it's going to blow up. And so it's less that I view it as good or bad, is that I view it as inevitable. Now, I think there are ways, I think, if you had a bear asset that could settle quickly, there's less of a reason to fractionally reserve it. And basically, whenever it attempts to be fractionally reserved, it's much more likely to break. Because people can pull it out quicker. There's less of a reason to put up with that risk, right? So I think that basically, as technology changes over time, with Bitcoin, for example, I think that can squeeze out the need for it.
Uh-huh.
But I think it's basically inevitable over the past number of centuries that it's going to be there.
Lyn further dives into the central bank, its policies and mode of action, and why the central bank can rarely run into problems like bank runs as compared to other commercial banks and financial institutions.
They're at the heart of the system, whereas major banks are the layer up. So you have an account with a bank. They provide services for you, and they have assets that back up those deposits. And some of those assets are stored at the central bank, which are liability for the central bank, which are then backed up by things like government bonds or other assets on the central bank balance sheet. So that's the main difference, is that, rather than a free banking system where every bank, has its own underlying assets like gold, for example, and has claims to them. Instead, most systems around the world are now central banking, which is that they're all connected to the central bank ledger. So that's the one difference, is just the layer. And then the second difference is really about what happens if they go insolvent, right? So, for example, if a normal bank goes insolvent, assuming it doesn't get a bailout, then it's at risk of, basically some sort of liquidation, forced buyout, some sort of thing like that. They have to be basically reconstructed. Whereas a central bank technically can survive with negative equity. And so they don't really have risk of bankruptcy in the same way that a normal bank does. They have different laws that govern their accounting, and they have just overall different constraints. A bank run can happen in a couple of different ways. The reason a normal bank run can happen is, you don't trust that bank. You're worried they're going to go bankrupt. They're not going to pay you back. So you pull your money out. And you have two choices to do with that money. You can either hold it in cash, or you can shift it to another bank. Let's say you're worried about Bank X, but you think Bank Y is safe, and so you pull it out to Bank Y. A central bank's a little bit different. In one, there's no alternative, at least within that country's currency system, right? So there's no competitor central bank that they're going to rush to. Now, if you look at international situations, that's different. But for example, there's no world where Bank of America, for example, wants to pull out of the Federal Reserve, because what are they going to do with it, right? There's no other thing to put it in. Number two is the central bank controls how much physical currency that there even is. And so they have two sides of their monetary base, which is bank reserves and physical currency. And, you can get a situation, if enough people want to do bank runs, or if you have something like that, there's only so much physical currency out there that they can even pull into. And so if enough people try to do bank runs, you'd actually get told no, even if the bank wasn't bankrupt. Like, even if it wasn't insolvent, they would just say there's literally a cash shortage, and we can't meet that demand for your claims being pulled out. And the central bank is what determines, every year, for example, a Federal Reserve tells the Bureau of Engraving and Printing how much physical currency they want to order, to determine basically what percentage of their monetary base they want to be in that physical form. So they, by basically controlling the parameters of what you can even withdraw from, they can avoid any sort of bank run scenario. Now they have other risks or downsides from having negative equity, and there's other risks that they can run into, but a bank run isn't really one of them.
Policymakers and regulators need to strike a balance between promoting economic growth and stability and ensuring that the banking system operates in a safe, sound, and sustainable manner. They need to ensure that banks maintain sufficient capital buffers, implement effective risk management practices, and have contingency plans in place to deal with crises. By doing so, they can help mitigate the risks and dangers of the fractional reserve system and promote a stable and sustainable financial system. According to Alden, the shortcomings of the banking system are something that Bitcoin resolves. Aside from being a Bitcoin maxi, other highly respected investors have commented on the banking system and the need to adopt other means of saving and accessing money like Bitcoin and gold without having to rely on banks that could crash at any time. What do you think about the banking system? Let us know your thoughts in the comment section below. Also remember to give us a like, subscribe, and turn on post notifications. Thanks for watching.